Hello everyone, you're very welcome back to the channel. Today we're talking about corporation tax in Ireland and how the country's greatest tax advantage is also the greatest threat to public finances. The Irish government recently published its Stability Programme update for spring 2023, which is one of two macroeconomic projection reports that the Irish government produces each year. In that report, it was estimated that Irish corporate tax receipts would reach 24.3 billion euro by the end of 2023, a year-over-year increase of 7% when compared to 2022. By the end of next year, it's estimated that corporate tax receipts will be at 25.1 billion euro. These receipts are very significant, primarily because they were totally unexpected. If you go back and look at the government's economic and fiscal outlook for 2020, which was released in 2019 pre-pandemic, you'll see that the estimation for corporate tax receipts in 2024 was 12.1 billion euro. Less than 4 years later, the revised estimate is more than double that figure. But it's not just corporate tax receipts that are outperforming. Income tax and VAT receipts for 2024 were projected to reach 30 billion and 18.2 billion euro respectively back in 2019. The revised estimation for next year puts the receipts at 34.9 and 22.4 billion euro, an increase of 16.3 and 23% respectively. The reasoning for this outperformance, according to the Irish government, is the post-pandemic rebound in economic activity, with notional gross domestic product increasing by an estimated 18% in 2022. A key factor behind the jump in GDP was the strong growth in corporate profitability, which in turn prompted an almost 50% increase in corporate tax receipts. Elsewhere, tax revenue increased by 14% in 2022, underpinned by the recovery in the labour market, i.e. income tax, and consumer spending, i.e. VAT. That sharp increase in corporate profitability and thus corporate tax receipts is likely the byproduct of both consumer demand outstripping available supply and price gouging or greedflation on the part of certain corporate entities. Idea being that some companies are profiteering off of the inflation narrative, which may partly explain why Fortune 500 companies generated record profits of $1.8 trillion in 2022. Nonetheless, the Irish Exchequer is benefiting from significantly higher levels of corporate profits being booked in Ireland. Ireland's labour market is also very strong. In March 2023, the Irish unemployment rate was 4.3%, which according to economists is the equivalent of full employment. Naturally, with full employment comes a higher income tax take, especially when rising wages are accounted for. In October 2022, Irish wage growth stood at 4.7%. Looking at the increase in consumer spending, we know that Irish household deposits increased by 44 billion euro between 2019 and January 2022, when total deposits hit a high of 131 billion euro. In 2020, the Irish household savings rate was 25%, representing the highest annual increase across the euro area for that year. In other words, the pandemic forced Irish households to save a lot of money because there was nothing for Irish households to spend money on. When restrictions were lifted, there was a huge surge in demand, not just in Ireland, but globally. That increase in consumer spending, combined with higher prices, results in higher VAT receipts for the Irish Exchequer. The bottom line is that post-pandemic economic conditions have facilitated strong growth in Irish tax receipts. The question is whether or not those receipts are sustainable. The sustainability of Irish tax receipts, specifically corporate tax receipts, matters quite a lot. Ireland already has one of the highest per capita debt burdens in the world. Based on gross national debt at the end of March 2023 and population statistics from 2021, Ireland's per capita debt burden is 46,870 euro. That's 46,870 euro worth of debt for every man, woman, and child in the country. What does this have to do with tax? Well, as we discussed in my video talking about the Irish debt situation, if tax receipts decline by a significant margin, the government will likely experience a deficit in the annual budget. A budget deficit arises when government expenditure exceeds government income, i.e. tax receipts. When this happens, the gap is often plugged by borrowing money, thereby expanding Ireland's already high per capita debt burden. So naturally, the sustainability of Irish tax receipts is in everyone's best interests. Unfortunately, when it comes to corporate tax receipts, Ireland has a sustainability problem. problem. Taking 2022 as an example, 27% of Ireland's tax take came from corporation tax. In other words, 1 in every €4 of all tax collected in Ireland is sourced from corporate entities. For context, a 2022 OECD paper revealed that in 2019, the average share of corporate tax revenues as a percentage of total tax revenues was 15% across 115 observed jurisdictions. At that time, no EU nation, including Ireland, had corporate tax revenues that accounted for more than 25% of the total tax take. The main point to note is that Ireland's share of corporate tax relative to other OECD countries is well above average. Why is this a bad thing? As was noted by the Commission on Taxation and Welfare in their report Foundations for the Future, long-term overdependence on corporation tax receipts poses significant sustainability risks and should be avoided. In essence, while it's good that Ireland is a current beneficiary of higher corporate tax receipts, it will be a mistake to rely on the continuation of these high receipts into the future. Reason being, if corporate tax receipts were to experience a shock, so too would Ireland's public finances. It isn't prudent to tie fiscal sustainability to the profitability of corporate entities, especially when the majority of the corporate tax take is coming from a small number of companies. In 2021, around 12.5% of Ireland's total tax take came from the corporation tax paid by just 10 large companies. You can imagine what would happen to Irish public finances if taxable profits from those companies were to experience a shock. In fact, you don't need to imagine. The government has estimated that windfall corporate tax receipts will equate to €12 billion in both 2023 and 2024. Windfall corporate tax receipts represent the portion of total corporate tax receipts that are unexpected, i.e. they weren't accounted for in the original estimations and could very well be temporary in nature. Therefore, roughly half of Ireland's total corporate tax take is at risk of being temporary. Now granted, actual receipts can beat out estimated receipts due to unforeseen macroeconomic circumstances, like we're experiencing right now, which can result in better than anticipated profitability. In theory, so long as those circumstances persist, so too will the improvement in tax receipts. However, when you're in a situation like Ireland's where receipts have grown by 229% since 2015, it's hard to envisage a scenario where these receipts are sustainable long term. That's especially true when you consider A, the OECD's two-pillar proposal for reforming global corporation tax, and B, future macroeconomic conditions. Under Pillar 2 of the OECD's two-pillar proposal, multinational companies operating in Ireland with turnovers greater than €750 million will be subject to a minimum effective corporate tax rate of 15% from the beginning of 2024. At present, although Ireland's base corporate tax rate is 12.5%, many companies pay a much lower effective rate due to tax reliefs such as the R&D tax credit and the knowledge development box. While this change should increase corporate tax revenues, it's actually Pillar 1 which poses the greatest threat to the sustainability of these receipts. Without going into too much detail, under Pillar 1, multinational companies will pay a portion of tax in countries where business activity is carried out and profits are earned, irrespective of whether or not the company has a physical presence in those countries. Ireland is a current beneficiary of the existing system perceived to be unfair, which allocates taxing rights based on physical presence. This is why many multinational companies decide to set up shop in Ireland to avail of the 12.5% rate of tax and the attractive tax reliefs. While details are still being finalised, it's estimated that the changes under Pillar 1 could cost Ireland €2 billion annually in corporate tax receipts. In terms of future macroeconomic conditions, it's hard to envisage that these record levels of corporate profitability will be sustainable in the face of higher interest rates and falling inflation. Inflation will normalise as higher rates continue to contract economic activity. The higher rates go, the greater the risk of recession becomes. With rates being as high as they are, and with consumers being squeezed as much as they are, demand will inevitably fall, and as a result, so too will prices. If there have been instances of price gouging, then in time, rising wages and subdued consumer demand should bring profits back down to normality. Of course, we don't know what central bank monetary policy will look like when inflation normalizes. The IMF believes that interest rates will fall back to pre-pandemic levels. Regardless of where you fall in that debate, there is a significant degree of uncertainty uncertainty around future macroeconomic conditions and what they could mean for corporate profitability and thus corporate tax receipts. So what are the potential consequences of Ireland's over-reliance on corporate tax receipts? It's important to reiterate that the government is fully aware of the fact that Ireland's current corporate tax take isn't sustainable. This is important because ultimately the government needs to decide how it will use the excess receipts that it's currently receiving. The mistake here would be to use the entirety of the excess receipts to fund tax cuts or permanent government spending. Reason being, if such spending was to occur, then when receipts inevitably do decline in the future, the government will likely be left with a large deficit, at which point they'd be faced with two choices. A, borrow money and expand the national debt in order to make up for the shortfall, or B, enter a period of austerity where government spending is reduced, neither of which are preferable. In the Department of Finance's 2022 report on public debt, it was noted that Ireland's projected debt-to-income ratio for 2025 is 73%. However, if a full elimination of windfall receipts was to occur, in addition to a reduction in economic output 5 percentage points below the baseline, Ireland's debt-to-income ratio would worsen to 100%. This is why the government has opted to make multi-billion euro deposits to the National Reserve Fund. Idea being that excess receipts received today are used to cushion the effects of lower receipts in the future. Even though the fund itself has limitations, not least of which is the fact that it's subject to an 8 billion euro limit, this use of funds is a prudent move by the government, one which has been supported by the Commission on Taxation and Welfare. Furthermore, the government is sticking to its 5% spending rule, whereby year-over-year increases in permanent spending are subject to a cap of 5%, which is the estimated sustainable nominal growth rate of the economy. Calls have also been made for a new sovereign wealth fund or pension reserve fund whose modus operandi would be the investment of excess corporate tax receipts in the hope of achieving an investment return that will help alleviate some of the burden associated with the mounting state pension crisis, which is a video in and of itself. In conclusion, insulating Irish public finances from shocks to corporate tax receipts has never been more important. Ireland has a number of expensive problems that it needs to solve: an aging Irish population, the Irish housing crisis, and the shift to carbon neutrality, among others. However, the funding which supports the solutions to these problems must be sustainable. The Irish government rightly wants to minimize the need to issue and/or refinance debt at higher interest rates. Equally, the Irish government wants to avoid austerity. Therefore, corporate tax receipts that are likely to be windfall in nature should be treated as if they were expected to disappear entirely in the near future. While the government is being prudent now, there is a concern that in the run-up to the 2025 general election, if Sinn Féin are favourites at that time, we could see the government dish out a series of once-off measures using excess receipts in order to sway voters in the polls. The conflict of interest between politics and public finances is a real thing, and it can prevent policymakers from making optimal decisions. But let me know, what are your thoughts on Ireland's corporate tax receipts? How do you think the government should be utilising these windfall amounts? Are you in agreement with their approach so far, or would you have liked things to be done differently? Let me know in the comments. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel, and sharing the video with family and friends. Before you go, you might be interested in this next video, which talks about Ireland's debt situation in more detail. Thanks very much for watching, and I'll see you soon.